people are like, why are prices going so much right now? And it's like, well, they were only low as they were over the past, especially, 10, 20 years, because we basically had all that disinflationary force of like constant globalization. And we've kind of, if you look at, say, global trade as a percentage of global GDP, that peaked back in 2008, 2009, and it's been going sideways ever since. So we had this long period of globalization, and then we're kind of consolidating with the amount of globalization that we have. And we could even be possibly taking a step back from that high level mark. And so some of those disinflationary pressures of globalization are not really present. And so this is kind of like what we're finding when prices actually are when you need to hire domestically, or when you're not in the constant state of outsourcing. So that's overall how I'm approaching it, and really kind of paying attention to fiscal stimulus, paying attention to wage and labor shortages and things like that. Another thing that's interesting is that, obviously the CPI includes hedonic adjustments. And so if, let's say, cars, for example, if you bought a Toyota Camry 25 years ago, it was like, half the amount of money, right? So roughly doubled in that time, if I remember roughly correctly. But if you look at cars CPI, it's basically flat since then, up a little bit, I think. And the reason is basically because they said, okay, the car is twice as expensive, but it's also so much better than the older one. So you have better navigation, better safety features, better gas mileage, and certainly it's better. The question, obviously, quantifying how much better is a tricky thing. However, one thing I'm seeing now is that services are getting worse, but of course we're not doing hedonic adjustments to increase the CPI, right? So we're paying more money for services that are generally, less pleasant or less efficient than they were 2 years ago. But of course that doesn't show up in the CPI. So it is, obviously it's always a challenge to manage a basket of measuring overall price increases. One of those challenging, obviously every investor has to determine really their individual time horizons. So some people like to do position trade, right? So they hold things for years or at least months. Other people like to swing trade or change things more frequently. But obviously most people shouldn't be active traders, right? I mean, that takes a lot of time. Your odds of outperforming what you're trying to trade against are low, especially after you include taxes. So for people that aren't professional traders, I think it's obviously good to have a very long-term view. I acknowledge that, because rates are so low, we're all kind of forced into these riskier assets, right? Because we can't, hold a ton of cash, it gets devalued. And so we're all kind of essentially monetizing other assets, right? So we're adding a monetary premium to other things because we want to own them, not just for the utility, but also because we'd rather own them than cash. And the risk there is that you get overvaluation and you have to deal with higher volatility. That's kind of the trade-off that you face. And so I do think people should focus, on valuation and also on basically euphoria, right? So when something goes up dramatically and then you pile into it, even if that ends up being a good investment over the next 10 years, that could do very poorly for 3 years because you bought into a big spike, for example. So that kind of goes back to my thing on energy. I think I'm just kind of holding energy, long term, and just kind of setting expectations that I don't necessarily expect this to double next year. It could just chop along and do its thing. But basically, when you look into the dividends that many of them pay and the overall value that you get in that industry compared to some other industries, it's certainly a place that I like to be overweight when looking out 5+ years. So if you look at the early, if you look at earlier in 2021, the first half, let's call it, we started to get this inflationary spike. Now, part of that was base effects. And then also part of it was measurable inflation. But interestingly, overall, owner's equivalent rent and rent inflation was still super low, at least in the U.S., which was what I tracked most closely. And so that inflation was happening without that big component, which, depending on which inflation measure you look at, is like 30 to 40% of the overall basket. And then we started to see basically home prices soar. But those official measures of housing inflation lag that and smooth that out a ton, right? And so we didn't really see it show up there yet. But something I've been tracking since around the middle of 2021, and that's really kind of starting to kick in now, is that those rent and those owner's equivalent rent measurements are going up now. They're basically catching up to some extent slowly with the big increase that we've seen in housing prices and overall real estate prices. And so now that basically some other areas may be cooling off, that overall housing component is what's driving it now and keeping it pretty sticky. So whether or not it drives it higher or whether it simply prevents it from coming down, remains to be seen. But I think that basically, for at least the next 2 quarters that I have visibility for in terms of this kind of rent and owner's equivalent rent situation, that looks very sticky for higher inflation. Basically going into, say, the middle of next year. So I think the last couple months were a little bit surprising. And so I kind of separated it into two phases. So from, where gold peaked in August 2020, and then kind of went into a big correction. That part was not surprising because we basically saw that real yields, they stopped decreasing from that point as measured by the TIPS market. In addition, you had pretty high euphoria in that kind of, period. And so I warned in my newsletter, for example, I was like, I'm still structurally bullish on gold, but I think it's, could very well take a break here. Bitcoin might be, kind of star of the show for a period of time. We've seen that. Now, where I was a little bit surprised was around that kind of March period. We started to see some bottoming signs of gold and gold stocks. And so I got a little bit more constructive on the space again. And we started to see, pretty good rally in April, but then it just rolled back over. And it's been, this sideways chop ever since, kind of sideways to down, kind of pretty weak price action. And so I think that was somewhat surprising, at least to me, to see how, kind of how weak it's been. And I did kind of eventually think that overall Bitcoin was probably a big chunk of that. So if people ask me in late 2020, do you think Bitcoin is stealing some of the liquidity out of gold? I would say it's not really big enough to matter. I don't think so. Gold's kind of behaving what I'd expect from real rates. But I would say that in 2021, Bitcoin's gotten big enough, and I am seeing signs that basically some of the gold liquidity has gone into Bitcoin instead. And so I think that in some ways, gold makes more sense when you combine it with Bitcoin, right? So if you looked at the market cap of gold and Bitcoin, that makes more sense with what's happening with inflation compared to just looking at gold alone, because people don't just have one kind of scarce money they can go into. There's a variety of things they can go into now, which is kind of diluting the whole space. So that's how I'm approaching it. I'm still bullish on gold for the next few years as a base case, because I think we're going to be in this period of structurally negative real rates. And if the bond market starts to wake up to that more, there's a lot of capital that could flow into, say, gold and silver that maybe is not on board with Bitcoin, for example. And so I'm kind of seeing how that's going to play out. I like to own both.